So our next question is not really a question, but a concept that we have to go over a lot in our client meetings is why trying to lose less is important.
Yeah, it's sort of a situation where, as a client, you don't want to lose anything. I mean, in an ideal world, you just make 10% every year and never have a loss. And there were periods of time you could do that at the banks, right, when interest rates were really high and you could buy a 10-year CD. But obviously that's not true today. Even with these higher interest rates, you can't do that. And so when you're in the stock market, you're going up and down to get that 10% or whatever you might be getting. And so there's some risk of loss there. And so one of the points that I try to make to people is that, anything that we can do to lose a little bit less than the market and still be pretty prepared for the upturn. Because there's two parts. There's lose less and there's recover faster. Those are both things that I focus on. You try to make some adjustments to portfolio to lose less while you're still keeping your eye on the recovery, the possible recovery. So, for example, I'll really focus on, what's happening in these up days, because those are the things I think might go up when things go up again and really start to recover. But there is some math behind this that's important to understand. So let me kind of share this little chart here that we made. So if you have a $100,000 investment and you have different levels of downturn, so let's say you lose 20%, you now have 80,000, right? So I have 80,000, I want to get back to 100. I have to make $20,000, right? Which comes out to a recovery return of 25%. So it's just simple math, but it makes a difference. So if you look at now, somebody else loses 33%, right? So now they have $66,700, give or take. They have to make 50% to get back to 100,000. Somebody who loses a 50% now has to make a 100% rate of return to get back to where they were at 100,000. So the less we lose, because there's kind of like this almost compounding factor there, the recovery return is going to be, much more manageable as far as that goes. So you have to be careful if you're trying to really, again, you have to bridge two pieces here, how much you come down and how fast you recover. Because if you get out all of a sudden in a panic and the market bounces back up, you just miss the recovery return. And then you get back in and it's slowly going up and it might take you a heck of a lot longer. So, there are periods of time, I think, where you probably want to get defensive as far as that goes, but they're pretty infrequent. We've only had, 4 massive downturns since the 70s, the 73 downturn, the 2000 downturn, the 2008 downturn, and the 2020 downturn, right? Those are the ones, if you could go back and get out halfway down, you'd be pretty darn happy, even if you didn't get back in at a perfect time. But most of the other times, you would have been better off just hanging in there and using other strategies. And that's my outlook. I'm really looking at the big downturns, and that's what I watch for. And I try to use other strategies like rebalancing, asset allocation, being in a couple target pieces that I try to pick to try to do better in certain situations, right? But this downturn pieces are really important, and it's very important to try to lose less on the downside, even if it's just a little, as long as you're positioned for that upside recovery, because that's where you get your money back. The market has gone up over time, no doubt. I mean, you pick all those big downturns, 73, market's way higher. 2000, huge downturn, hit us here in Silicon Valley. I still wish I would have bought at the top because I'd still have money. I wish I'd have bought at the top in 2008 because I still would have made money. If I'd have bought the top in 220, it's higher now, right? So the market comes back, at least so far. And so, and that's the key issue, is just to kind of have that overall outlook and understand kind of what's happening in the long term too. But generally speaking, losing less is a really, really good idea. And ultimately, up to those big downturns, you want to just try to structure the portfolio for something that you think is going to recover really well. That's what I do, but might fall a little bit less. I feel like our current portfolio has done a really good job with that so far this year. So, that's what we're trying to accomplish there. So, yeah, it's a good question. It's a very, very interesting area.